the Fortress Investment Forum 2023. My name is Caroline C.C. Reid, and it's my pleasure to be the MC once again. After a few years, we're back, and we're so pleased once again that you're here with us. Now, we did have an announcement that you have to turn off your mobile devices, but just as a note, a little later on in this evening's proceedings, we are going to have a Q&A, which will involve you using WhatsApp if possible. We do invite you, of course, to ask your questions in person out loud, but if you prefer to use WhatsApp, that will be coming on a little later on. But of course, it's Fortress Investment Forum 2023. It's going to be a very interesting, educational, informative session, and we look forward to hearing from the Fortress team. So at this time, I would like to invite the Investment Director, Mr. Roger Cave, to start this evening's proceedings.
Thank you, Caroline, and good evening, ladies and gentlemen. A very warm welcome to all of you here this evening to our 11th Fortress Investment Forum. Our title this evening is Investment Strategies for Changing Times. It's great to be back at Frank Cullimore Hall and to see so many familiar faces and lots of new ones. And again, thank you for giving up your time to be with us here this evening, especially given the rainy conditions. We're here tonight to discuss financial security, which we at Fortress, along with many of you, believe is an extremely important aspect of life. So what does financial security mean? Well, very simply, it means to be able to afford and keep affording on your own terms what is necessary and important to you. This is something that every one of us should strive for, and it doesn't happen by accident. It takes deliberate action. And we at Fortress offer the products, the services, systems with easy-to-start monthly direct debit plans to help investors of all kinds achieve financial security. An essential role in managing your savings and investments is to report and communicate with you on exactly what is happening with your money. As you all know, we do this through the weekly updates of our website on weekly NAVs and how they're changing, quarterly reports, annual reports, press releases, regular statements, and of course, this important Fortress Investment Forum. There really is nothing like face-to-face interaction, and to hear firsthand from our investment team, Rashada Lopez and Peter Aranda, who will cover updates on the Fortress funds for 2023 and the first quarter, of 2022 and the first quarter of 2023, along with updates on financial markets locally, regionally, and internationally, which have become very much more important to us at Fortress. Before hearing from the investment team, though, our Fortress Director, the esteemed René Delmas, will take us down memory lane on pensions. We're sure to hear from him talk about hope. Sadly, it seems that we're now relying more on hope, but more from him on that. After the presentations, which are really only the appetizer, the main course is the Q&A. So we think this is the most valuable part of the evening, where we will have an open and honest communication. As we called it in one of our earlier investment forums, it's going to be straight talk from our investment team, and we look forward to your questions. A quick update on what's been happening at Fortress over the last year. We continued our 25-year celebrations, and one of the things we did, supported a number of local charities which were chosen by the various members of the Fortress team. We planted 100 trees one afternoon on the Barbados Trailway in St. George. This really is a super project and deserves lots of support, and for those who haven't seen it, I encourage you to go and look at it. Our assets under management, which you'll see from this chart, is over the last 5 years, have grown steadily, a bit of a dip in 2022 due to the declines in NAVs, but now total over 800 million in assets. In 2022, we had net new subscriptions of 7 million with over 500 new clients. US mutual funds have become more and more important part of the Fortress product offering, and we now manage 7 US dollar funds, 2 domiciled right here in Barbados, were started 2 years ago, just into the pandemic. And they've grown nicely to over 15 million US in assets, with over 50 shareholders. We have our 5 Fortress global funds that are domiciled in the Cayman Islands. They now total over US $200 million in assets, and we have now passed a 10-year track record for them: US equities, international equities, emerging markets, and US fixed income. Actually, in 2022, those funds outperformed their international benchmarks, some by a significant margin. Late in 22, we've embarked on a significant software project to upgrade and digitize our systems so we can continue to deliver exceptional customer service to our investors. And we're delighted to report that Rashada Lopez passed the dreaded level 3 CFA exams last year. So we now have 3 CFA charter holders looking after your investments. So 2022, what a year it was for financial markets. The main stories were we had the war in Ukraine, we had supply chain disruptions, we had pent-up demand. All of these things led to increased energy prices and then higher inflation. And as a result, central banks everywhere hiked interest rates significantly. The impact of all of this was significant declines in equity and bond prices. So, to be truthful though, for me, and probably for most of the Fortress team, this was nothing unusual. And you'll see from this graph goes back to 1996, it's the Fortress Caribbean Growth Fund, and there's always some bumps along the way, but a dollar has grown so nicely to over $7 today, and many of you were with us from the beginning, have been well rewarded for staying the course. To me, one of the more disconcerting developments in Barbados was the policy change back in 2015, resulting in double taxation of pension contributions. We are a significant player in this business, so we're seeing firsthand the impact it is having, and it is truly troubling. René will cover this next, but before handing over to him, I would like to sincerely thank the exceptional team, the current and past directors that together have all contributed to make this wonderful company, Fortress, what it is today. You would have seen from the emails sent to many of you and in the press the pending organizational changes recently announced, which coincide with the upcoming retirement of Mr. John Williams as the CEO of Cave Shepherd, and I will be assuming that role from the beginning of June. Thankfully, John has agreed to continue on as a non-executive director of the Fortress boards, and we're delighted about that. I will be assuming the role of chairman of Fortress, and Mr. Peter Aranda, the CEO of Fortress. So, a few changes, but I want to assure you that as we embark on the next 25 years, that while some of our people and our roles may change, this company, our project, and our mutual funds will not. Going forward, Fortress is truly in great hands. And with the Fortress investment team, I now hand you over to Mr. René Delmas. Thank you.
My topic has really changed through the years. We're going to be looking back very, very briefly. I've selected some slides from over the years to highlight what's changed and what's not. A lot of people will come to me and say, but I've heard this time and time again, but that's how Fortress operates. There are a lot of investment principles that don't change, and we'll stick by them through thick and thin. Others will, and I'll report on that. And it's mainly on the pensions that I will be reporting. So that will include national insurance, group pension, and individual pension plans. So we'll start with a slide here from 2010. That's my favorite saying, hope is not a strategy. So for all of you who are thinking of winning the lotto, thinking of getting some inheritance from Aunt Betsy in Nebraska, I urge you not to hope. So as you would have heard from Roger, and you're going to continually hear from us, hope is not a strategy. It takes deliberate action and planning to plan for your retirement. The big one there that has changed is the last one that Roger alluded to earlier. That has had a significant impact on our business There's been a real slowdown of new pension plans, slowdown of individuals electing to establish RRSPs, individual pension plans. And we've been lobbied government. We've done that many, many times, and so far there's been no change in the tax policy. We would like, obviously, that to be reconsidered, even not maybe to the extent of what used to exist back in 2015, but we'll see how it goes. But that has impacted us significantly. We had a seminar back in 2012 which was very focused on NES. It was at UWI. We had the late Mr. Frank Alleen, the then principal of ECLA, Charles Herbert, Professor Justin Robinson, and we focused a lot on NES. Why? Because NES is important. It's a significant, the largest pension plan in Barbados. And, you know, when we talk about NES, it is not that we are trying to gain any cheap political points, you know, or taking any bash at any government. It is because it is our money, it's our fund. We think it's very important that the governance is there to get it right, to make it financially sustainable for all of us, because it's our contributions. So whenever we see an issue, we're going to raise it because we think it's important. Now, this is from a report from the actuary in 2008. And just to show you back then, there was a limit that the actuary spoke about of the assets in government securities, 57% back then. It was an issue then, and it's not an issue now because that number is over 70%. It's worrying. So we raised it. These were the actuary's recommendations at the end. I think basically just saying, don't rely on NES. You have to make other arrangements for your retirement. We know a lot has happened about NES, and I'll come to that a bit later as well. We don't know what those changes are going to be, and let's hope we get to them very soon. The other thing at Fortress we have done over the time is that we've tried to respond to markets. One of the things, a few people came to us and said they were not very happy with the annuity rates when they were retiring. Could we offer something else? And this is not a bash of annuities. Certain people just prefer to take that risk. Even though their pension will fluctuate, they retain the ownership. And that's what the drawdown does. So it's just an example of Fortress responding to market needs. This was back in 2014 and has been very popular for people who have sizable lump sums at retirement. Annuity has its place in the market, and that's fine. This was from 2015. I think Peter Arnder, who you'll hear from shortly, he's, I think, a big Star Wars fan, so he always uses this word force. But no magic in accumulating for retirement. You just got to do it. Okay? And it can be very simple. Everybody says, when is a good time to invest? I say now. Forget about the noise, the ups and downs of the markets. I know it can be scary, but now is the best time to invest. Moving on to 2016. Hope is not a strategy. There it is again. No rocket science. So there's the repetition of those principles that will not change at Fortress. This was a slide that attempted to explain the sort of growth and evolution of pensions. And the first NES scheme started in Germany back in the late 1800s by this fellow called, let me get this right, Otto von Bismarck. He was a German chancellor. And he's credited with introducing NES for the first, Social Security for the first time. He was a smart guy because he put the retirement age at 70. But back in 1890, the expected lifetime was 55. So he got a lot of money on his hands, and he used the funds wisely because Germany then went into a war in 1914. Be that as it may, it was the model from which the US and UK governments modeled their Social Security on. After that came defined benefit plans, which were very popular up until the 90s. It was great for employees because they didn't take the risk, the employer did. But then the employer said, hey, I don't like this a non-financial liability. I think I'm going to get out of this and go to defined contribution plans, which then put all the risk on the employee. So the pendulum has swung really from one end to the next. And I think the solution lies somewhere in the middle. But it is worrying, as I mentioned before, where people are concerned that this double taxation anomaly that we face in Barbados is affecting employers wanting to introduce pension plans and individuals. So we are hoping for a change. 2019, back to national insurance. And again, we're raising these issues because we are concerned and we want it addressed. And I can only hope that the changes that are coming, or I think that are coming, from national insurance will address this objective. Because if we don't have a financial sustainable plan for national insurance and we pass that on to our generation, I think that's a huge disservice. We've got to have a plan that is financially sustainable. If that means a cut in benefits, well, I say personally, so be it. 2022, which was only last year, again, there's a common theme coming through. To get from A to B, have a plan. Start now, and you'll get there. So, in summary of the pensions, there have been some changes, not only the removal of the tax allowances. The big one, of course, are the changes coming down from national insurance. We haven't yet heard from the government what those changes will be. But they will come, they have to come. And I really hope that that double taxation gets fixed somewhat. And hope it's not a strategy. Thank you very much. And it's my great pleasure to introduce to you one of the newest members of staff who recently passed a Chartered Financial Analyst course, becoming the third one at Fortress. And she'll talk about the market review and performance for 2022. So it's my great pleasure to introduce you to Rashada Lopez.
Good evening, everyone. This evening, I'm going to briefly walk you through our market performance, the market overview, and the fund performance for 2022 and the first quarter of 2023. So 2022 was a relatively strange year in the investing world, and that is because central banks all over the world had to rapidly raise policy rates to rein in inflation. So what ended up happening is that both stocks and bonds were abnormally volatile, and also stocks and bonds were both negative during the year. This is a chart which shows the bond volatility measured by the MOVE index, that's the yellow line, and the VIX measures the equity volatility, which is the light blue line. And this chart shows that in 2022, the yellow line, which is bond volatility, was abnormally high. The only other part in this chart which is comparable to 2022 was in 2020, and that was because of COVID. So in 2022, there was a lot of negative performance in the markets, both stocks and bonds, but bonds were also quite unusually volatile. If you take a look at the VIX, which is the light blue line, it appears as though stocks had a relatively normal year. And this is because it's normal for stocks to move up and down very widely. That's a feature of stocks, but not really the case for bonds. As a result of all the strangeness in the markets, most markets were negative in the year. And examples of this is the S&P 500, which tracks the performance of large cap US equities. That market was down by 18%. Another example of how markets performed during the year is the Bloomberg US aggregate. That tracks the performance of both treasuries, and U.S. corporate bonds, and that was down 13% during the year. A portfolio which comprises of 60% equities and 40% bonds would have been down 16% over the year. And the theoretical premise for having a portfolio that comprises of both stocks and bonds is that it's usually less volatile and less risky than a portfolio that comprises of 100% equities. But this year, both stocks and bonds were down a lot. Both stocks and bonds were positively correlated. So the rationale for having a 60-40 portfolio really didn't work during this year. Some of the sectors that saw the more acute declines in the year was the speculative parts of the market. Like, for example, the S&P crypto broad digital market was down almost 70%. The NASDAQ, which has the growthier parts of the market, including tech, was down 33%. But if you take a look at this table and you go all the way down, the S&P value was down only 5%. And value really held its own during this year. The only market that performed positively during the year was commodities, and that was broadly due to energy. So in line with the broad market performance, all of our funds were negative over the year. The Caribbean Growth Fund, which is our flagship fund, was down almost 6%, while the Caribbean High Interest Fund was down almost 3%. And you can see in this chart, the Caribbean Growth Fund was down by a lot less than our US dollar funds, and that is thanks to diversification working here to protect the Caribbean Growth Fund from the down performance in the global equities. Despite our funds performing negatively during the year, our funds were mostly outperforming their relative benchmarks, with the exception of our emerging markets fund. So let's get into some of the drivers of our performance for the year. Some of the factors which would have contributed negatively to our performance is our emerging equities. Emerging equities was a sector that was relatively weak during the year, that attributable to China equities and also equities in Russia, and those were negatively impacted by the invasion of Ukraine. Also, our funds were underweight energy and underweight commodities, and these were the two markets and asset classes that had positive performance during the year, so we weren't able to capture the performance from those markets and asset classes. So some of the tailwinds are the factors that would have performed positively for us was our focus on value. We're value investors. We are very value conscious, which means that we like to go for equities that are trading at relatively cheap valuations compared to the more speculative parts of the market that would be more expensive. And because of that, when the more speculative parts of the market were hit during the year, value held in relatively well, and we didn't experience the large downdrafts in the speculative parts of the market. Also, another factor that helped our Caribbean Growth Fund specifically held in well during the year is our holdings in Guyana. Guyana was a sector that rallied significantly during the year thanks to the explorations in oil in that country, and because of the embedded growth rates in GDP being captured in some of the valuations in Guyana, that sector rallied. As a result, though, we like to buy on weakness and sell on strength, and during the year, we tried to capture some of the profits there by trimming some of our allocations in Guyana. We were also underweight Jamaica, and this really benefited us during the year. Jamaica, like Guyana, rallied significantly during 2019, and as a result of that, we trimmed some of our weighting there, and when that country experienced a downdraft in equities this year, the Caribbean Growth Fund was properly insulated from that performance. So the markets really bottomed in the third quarter of 2022 and has since regained some of the ground lost since then. This is a short-term graph of the Caribbean Growth Fund, and it shows that theme coming out here. the Caribbean Growth Fund reached its lowest intra-year levels in the third quarter of 2022, but since then the markets have recovered somewhat and the Caribbean Growth Fund is trending upwards again. So now we get into the first quarter of 2023, our performance and what are some of the changing dynamics that we're seeing in the market. So one of the most important dynamics that we're seeing coming through is the notion that the Fed might be soon done on its aggressive monetary policy stance. And this is as a result of some general weakness in the economy, but also more recently, the banking sector risk that has occurred in the US has led market participants, including us, to believe that the Fed might be soon pivoting to either a pause or shifting to reduce rates if the Fed wants to engineer a soft landing and not really push the US economy into a recession. Another reason that leads us to believe that the Fed might be closer to a more restrictive level on monetary policy is that we see inflation moderating. This is a consumer price index chart spanning back to 2018, and as a result of all the pent-up demand in the system after COVID, inflation really spiked. So the Fed and other global central banks stepped in to initiate aggressive monetary policy to rein in inflation. And this chart shows that in 2023, especially the first quarter of that year, we see that transmission mechanism coming through and inflation moderating. So signs like these really convict us to believing that the Fed is closer to either pausing or reducing interest rates. So as a result of the reduced interest rate policies, we believe that the Fed is therefore near a restrictive level on interest rates. And because of that, other market participants also believe that the Fed is near their restrictive level on interest rates. So thankfully to that, the funds performed positively during the first quarter of 2023. While the markets were down in 2022, we added on weakness and we added to some of the global funds and some of the global equities when they were in their weaker parts of 2022. So thankfully for that, our markets gained in the first quarter of 2023. So now we get into some drivers of our 2023 first quarter performance. So one thing that kind of hindered our performance during the year is that we are generally underweight tech. And that is because we're value conscious investors and tech is just that part of the market that is more speculative and generally has higher valuation. So while tech performed positively during this year, we weren't able to capture that because we're not really into tech since we are value conscious investors. Some tailwinds that would have benefited the portfolio is that we didn't have any US regional banks in the portfolio. Recently, US regional banks came under stress as a result of having to realize unrealized bond losses. And so when those stocks negatively performed during the year, the portfolio was properly insulated, or rather we weren't exposed to the risk in the US regional banks. Another factor that benefited us during the year is our allocations in international equity. That particular part of the fund really rallied in the first quarter of the year, and we also saw meaningful gains in the international equity fund, thankfully to gains in the international currencies' strength against the US dollar. And now I will hand over to my colleague Peter Arender, who will go through the investment strategy and outlook for the rest of the year. Thank you.
It's really great to be back here in person. I see many people here who were with us for our very first investment forum, which was many, many years ago. We had to press pause over the pandemic, and it is just really a pleasure to be back here with you all. You were promised a talk tonight about change, and I think I'll be delivering a little bit of that. I hope in the Q&A, which will start in just a few minutes once I wrap up, that we can explore some more of the points and questions you might have about some of the changes in the world, because as Rashada mentioned, last year was a really odd year. Bonds don't normally move like they did last year. It was quite dramatic. I'm going to touch on a few things that I believe would suggest to you have changed, 4 things in fact, and 3 that I'd suggest have not. And then how are we responding? How at Fortress are we responding to this uncertainty and this change? In general, we're not people who try to predict what the future is going to do, because you can't. What we're focusing on is trying to make our portfolios, whether they're stocks or bonds, whether they're Caribbean regional or whether they're global, trying to make them as resilient as possible to a range of possible outcomes. So on to change. First, let's have a look at a couple of things that may have changed. Last year's movement in the bond market was truly remarkable. And this is a graph of 5-year treasury yields going back for the last 30-odd years. Bond investors have been eating bugs off the floor for the last 10 years. You can now earn an okay income owning bonds again. That is a really big difference, and I think it has impacts for balanced portfolios, as Rashada mentioned, the old 60-40. It has implications for folks who have cash. And I think the thing to bear in mind here is if the Fed does cut rates, if short-term rates do fall, cash rates will fall too, but bonds will rally. Okay, so we have bond yields are higher again. That is change number 1. Change number 2, I would suggest, is that the US economic slowdown that has been much talked about, much feared, much dreaded, is finally here. This is a graph of the Philadelphia Fed Index, sort of a survey in the US of economic conditions going back the same odd 30 years. When it gets down this low, it's almost always a recession. The question is, how bad a recession is it going to be? Nobody knows. The good news is, once we're in a recession, it probably means the central banks are either done or almost done tightening monetary policy. It also means, in the perverse backwards thinking of financial markets, that once a recession starts, we're close to it finishing, and once it finishes, we can rally the stock markets again. So I'd suggest that this is a change now that would suggest that owning cash again is a bit of a difficult proposition, because either interest rates are going to come down, causing bonds to rally, or stocks are going to improve from there. So number 2 change, the US economy is slowing down. Another argument for focusing on resilience in portfolios as much as you can, because we don't know what tomorrow holds. The third change is one that's possibly more durable, and I think might be the one I would suggest is the most important of the 4 I'm going to mention tonight. This is inflation. This is the same graph I believe we were just looking at a second ago in terms of inflation going back the last 5-7 years. We've had inflation around 2% in the US for a long time. I think we've gotten spoiled. And the expectation seems to be that it's going to come down to 2% again right away. And I suggest we maybe have a bigger problem than that. It doesn't mean that inflation needs to stay as ridiculously high as it has been. A lot of the factors at play that led it to be high have passed. But I think it might bubble along a little higher than people think for a while longer. And the biggest problem behind that, I would say, is political. This is a graph of money supply in the US, with the red arrow pointing at where the pandemic was. We all know governments were giving away, many governments, especially the US and all around the world, were giving away money. There was fiscal spend in that time to support the economy. And it didn't go unnoticed by voters. Protests are happening now. Everybody knows now that if push comes to shove, governments will open their checkbooks again. And the old saying goes that everywhere and always inflation is a monetary phenomenon. And I would take the slight variation on that and suggest to you that it is everywhere and always a political phenomenon, because it's the governments that decide to spend that causes inflation. And this can of worms has been opened. So I think you may see a little bit more inflation bubbling along than we've seen in the past. Fourth and finally would be something to do with trade. I think it's fair to say that some things having to do with trade have changed. Some geopolitics have changed. This is a graph of Chinese exports to the United States going back to the late 90s. Up and down because of seasonal things. Different times of year you need more stuff. But the yellow line is the trend line over that time. Now maybe I'm cheating a bit, because you could say, well, that hasn't changed. I think you kind of need to look behind it. And I think what's changed is, in the last few years, there's been a recognition that there needs to be more diversification in where this stuff comes from. Other relationships for the big economies in the world. So think of places like Japan, Canada, Mexico, Korea benefiting as decisions get made to arrange for fewer exports from China. How are we responding to the raised geopolitical risks? I would say at the margin, we also are preferring to diversify away from places like China in our investments. They're still a big part of our emerging markets portfolio. It has to be. There's great value there. But we're very, very conscious of the risk in the ecosystems, if you will, of where the stocks and the companies are operating. Sometimes the details change, but the big things stay the same. And thankfully, there are a few big things that have stayed the same. The first is the business of owning businesses. This is a graph of the S&P 500 index of large cap US stocks going back about 30 years. Things move around, but they generally go up. The way to think about it, I suggest to you, is something like this, where under the surface, you should imagine, as long as you own shares in good profitable companies, that gradually increasing. What the wiggling is the market prices. And the eternal truth I would suggest to you that hasn't changed is that market prices move around a lot more than the underlying fundamentals. So, hasn't changed. Number two thing that hasn't changed would be that investing sensibly matters. And by that, as value-conscious investors, we believe it means paying a lot of attention to what you're paying or what you're getting. We just don't think you can get around it. You have to pay attention to what you're paying. It's nice to think about what you're getting, but what you're paying matters. Low prices today mean higher returns for the future. It sometimes means that owning shares in companies whose products we like doesn't necessarily make a good investment. We mentioned an example of that last year. I apologize if my wife's in the audience. I can't see her, but this is a photo from our fridge at home the other day. Possibly the only presentation you've been to in Frank Collmore Hall with a photograph of my refrigerator. I hope it is. We mentioned Oatly last year. We mentioned it because it had recently gone public. A lot of frenzy. Probably everybody in the room has had their products. We love them at work, love them at home, but they don't make any money. They didn't then, they haven't now. And when we think of it as an investment, this is not the type of thing, drink the milk, but we won't want to buy the stock. And so the stock was down 80-odd% from its highs when we had our virtual seminar last year. It's down another 50% from $5 to $2 in the last year. So that's just an example of product versus stock. So what are we doing in terms of valuations? We're focusing on larger, profitable, ideally growing companies everywhere in the world. And this is an example here of some of the output that we get from the numbers, the crunching of the numbers in our US, international, and emerging markets funds, where the characteristics are better than the overall market, so better than owning the overall index in our view, and the valuations are better. And they're good in absolute terms. One good shorthand is the price-to-earnings ratio, which we've abbreviated on the right-hand side, PE. P's of 15, 12, 8 in emerging markets. Those are all still very consistent with above-average returns for the future. The last thing that hasn't changed, I suggest to you, is that it's a big world. This is the world, and the red dot is us. So I think the message from an investment point of view is that it's important to diversify. Diversify, diversify, diversify. Closer to home, right here, a couple of things to bring up. A cartoon from the Nation newspaper the other day. The government of Barbados is again issuing large quantities of domestic bonds after taking a break following the 2018 restructuring. It's a feature of the previous restructured bonds that their coupons, the amount of interest they pay, is automatically increasing as time goes by. So I think all of us here in Barbados need to recognize that after the honeymoon phase, after 2018 of very low or almost zero coupons on many of the restructured bonds, those rates are starting to tick up. And the ticking up was built on the premise that economic growth above and beyond the levels we saw in 2018 would be happening by now. There'd be a big growth trajectory in order to pay these off. So we have to ask ourselves, has that happened? Or has risk risen? And I suggest to you the risk has risen again. Elsewhere in the Caribbean financial institutions probably are not immune to the kinds of stress that has hit the US regional banks in terms of their financial portfolios and the balance sheets. So I think it's another potential source of vulnerability here in the region we need to keep our eyes on. So risk returning to the region. Again, how do you respond? Please to diversify. What's the outlook from here? Well, Yogi Berra said, predictions are very hard, especially about the future. With lower prices, expected returns are all better. Bonds, stocks, just about everything. Bonds, maybe not great again, but they're pretty good again. So something to bear in mind relative to cash and other things. The assumption inflation is going to come right back down where it was. Maybe we should think about that for a little while. Maybe inflation will stay a little higher than normal for a while, and even if interest rates come down, that's something to bear in mind. Global diversification as important as ever, if not more so. We're finding great stocks to buy in the US, Europe, Japan, rest of Asia, some in the Caribbean, not as many. We can touch on that in a bit if you like. But there are good stocks to own at good prices, we think with good return. And the risks in the region are rising. So changes, some no changes, how are we responding to the change? As always, our operation is about trying to find undervalued, well-valued securities that are high quality. I think the thing in the current set of circumstances that we're focusing on as much is how to build as much resilience as we can into the portfolios by owning different kinds of securities that will do better or worse in different kinds of scenarios to cover off more kinds of scenarios. So good assets at good prices and well diversified. And with that, I'll conclude and look forward to your questions. Thank you all very much.
Thank you. Of course, thank you to all those who presented from Team Fortress. Very informative and I hope thought-provoking presentations, because I would like to welcome the marketing manager for Fortress Investment, Kim Howard, who's going to lead the question and answer segment.
Thank you, Cece, and good evening, everyone. Welcome again to the Fortress Investment Forum here at the Frank Collymore Hall for the first time in 4 years. We're very glad to be back here. We, of course, would appreciate all of your questions. That's why we've set this up from the audience. So just raise your hand. These people you see coming down the stairs, they have microphones. Once they see your hand up, they'll make their way to you. But you can also submit your questions via WhatsApp. But this is definitely a situation where we prefer for you to ask your questions right here. So, Fortress Investment Team, how are y'all doing?
We're good.
Good.
Good evening.
Good evening. And I know, Peter, you told me you had a question for the audience.
Forgive me, but may I ask a question of the audience first? And then you can get even with me by asking tough questions. Could I ask for a show of hands? This is not a tough question. This is kind of what we call an ESG question. If it were possible, and I'm not saying it is, but if it were possible for us to develop a mutual fund that was completely environmentally clean in its operations and what it owned, and it was just socially pure, I was wondering if you all would accept a 2% per year lower return relative to what you're in right now to own that fund. Could I have a show of hands of who would say yes to that? I'll take the 2% lower fee, or lower, not fee, sorry, lower return. So this is, so a few people would take, you would accept 2% lower for a pure, clean, thank you. No, this is great. We're asking to know. This is all very good. It doesn't seem an overwhelming yes, though. It feels like there are some yeses. Okay.
Maybe they're undecided.
That's really helpful, thank you. Okay, on to your questions now. Thank you very much.
Okay, and that WhatsApp number is 248-5642. But I would love the first question to come from the audience. We've got somebody down front here.
Hi, good evening, Fortress team. I wouldn't be so hasty to conclude that was not an overwhelming yes. I think a few people might not have put their hands up on the ESG question. A geopolitical question to kick off. I think Rashada mentioned very briefly about the war in the Ukraine. Could we have, but you didn't touch on it too much in terms of, looking forward. Insofar as the Russia-Ukraine war is a proxy for a war between the US and China, what are your thoughts on how that plays out, and what are the things we should be worrying about?
Thank you all for coming tonight.
Do you face those questions all the time?
I do. These types of questions are known to me. It is absolutely, maybe I'll take a stab at that and then please chip in, which is kind of how we'll operate tonight. We'll all try to answer, and hopefully you can get something that approaches an answer. We don't know. I mean, we're sitting on stage. Nobody knows what happens next. But I think the only rational thing to do in the face of what has gone on in the last year is to alter how you assume or alter your assumptions about how safe capital is everywhere in the world. Is capital equally safe everywhere in the world? And I would argue that the thing that was most chilling, what I would call the big chill moment, the older people can recognize the movie, but the chilling moment after the invasion of Ukraine was on the sanctions front when US dollar access was dropped down on Russian entities. Because that, almost more so than the invasion, registered a raised risk for capital. And that was different than what we'd seen before, at least in recent memory. So I think the answer is yes. It wasn't just the invasion, it was the response to it that in some way is showing everywhere, showing everyone in the world that capital is not always safe where it is, and one needs to think pretty hard about where things are. So in terms of what we've done, we are investors in China. Our 50-odd% of the emerging markets index is China. They're good companies to own there. But at the margin, are we investing greater quantities in China? No. Are we keeping, as we like to call it, the emerging markets cheapness in its box, in an overall portfolio? Yeah. I think just by risk management to respond to it, but nobody knows, but I think yes, we do need to respond to it, and I think the biggest answer is that it's made the world riskier for capital.
Yeah, I would just add to that we did have a few Russian shares in our emerging markets portfolio, and they were great companies at very, very good prices, and still are great companies, Sberbank and Lukoil, and they've gone to zero. And it really is tough when you watch an investment go to zero, and the rest of the world really went against Russia, and those who had investments there, they're gone. And if we found a scenario where China and Taiwan went the direction which we all hope it wouldn't, what might happen then in terms of the rest of the world on Chinese investments? So, not a nice thought to start the evening, but it really is the reality that, and I'm a huge fan of emerging markets because I love value and I love cheap stocks, but I think I learned a lesson out of it, and I think we all should. It means that, as Peter said, we should diversify more.
Yeah, and maybe one last point on that brings us into something like an eternal example. These are facts that we might respond to, but as a general rule, by the time we're able to read about it and all talk about it as though it's a known thing, it's probably in the prices of the assets already. And a large part of our job is not just to assess what makes sense financially to things, but to try to figure out what's already in the price. And as I say, a good rule of thumb is when it's preoccupying everybody, it's probably already in the price. But that covers most things. I think in this case, it deserves some special attention. That's all.
Peter,
Thank you.
could you clarify what you mean by that when you say that by the time it becomes a known thing, it's already in the price? For those of us who are not CFA charter holders.
What I mean by that, I guess, if you think of it like an idea about something spreading like a disease, in this maybe an idea or a message, if it started in one part of this room and it spread all around, it starts small, not everybody knows what it is, but then it moves and some more people know, and then more people know, and then more. And if you imagine that as that's happening, asset prices are adjusting based on more people determining that this asset should be sold or bought. So I always think of it as it's almost like it's a gradual convincing of people to a critical mass. And once everybody in this room either knows something or has the disease or whatever it is we're talking about, there's nobody else to convince. And once you've convinced everybody, the market's done moving. So I think I would look at market movements as another way to interpret them as evidence of convincing people, new people getting convinced. Because people who are already convinced don't need to sell or buy anymore. They've already done it. So that's kind of, if that makes sense, but that's how I would think about it.
I think that clarifies that. We have a question here regarding the US dollar, which is pretty much ubiquitous in the investment world. How are investments affected from the apparent move away from the US dollar? Is a move from the US dollar even possible? Well, tell us, is there a move, an apparent move away?
I think I could take a stab at that. From what we can see, I wouldn't say that there is a large shift away from the U.S. dollar. The U.S. dollar is currently the main trading currency that there is. So to say that there is a move away from it would be not factual. But there is risk relating to the U.S. dollar like there is with other currencies, and as the risk builds there, even with inflation. If inflation continues to remain high in the U.S. compared to other countries, you could see the currency of the U.S. dollar weakening against other currencies, and if that has an impact on our holdings, yes, it does. If there is a weakening in the U.S. dollar, we have U.S. dollar holdings, so the valuations of our U.S. dollar holdings when currency converted would be lower. But to say that there is a gradual move, or to even think that there is a shift away from the U.S. dollar to the point where it would be detrimental for our holdings, I would say not really.
I would agree. I'd say it's not even close. Another window to look at it would be if you're looking to invest in financial assets, there just isn't a market anywhere near the depth and breadth of the U.S. financial markets. It's not like there's two others that are almost kind of close, and then a lot of others that are sort of third place and pretty close. It's not even close. I mean, we'll talk about emerging markets and some international markets, even in Europe, as though they're all comparable to, say, the U.S., and it just isn't the case. So if people are looking to deploy capital for any number of reasons, maybe people would wish that it were differently balanced in the world, but to describe how it is now, like, it's just not even close.
Any questions from the audience?
Hi, good evening. Thanks very much for your time here tonight. I'm just trying to understand, Peter, you had mentioned earlier about good companies that have good results and good profits should be sustainable in the market, and that should keep the values or whatever. But if we go into a long-term inflation malaise in the U.S., and there's also some comments now that credit card debt and just debt in general in the U.S. is mounting. So, all that really nice Santa Claus cash that came out during COVID may have dried up somewhat. Where is that likely to manifest itself across the equities in the next period of time as that inflation kind of beds in for longer than as you were alluding to? What kind of industries are likely to be most hit or affected by that?
Well, thank you for the question. I think you think I'm a lot smarter than I am. Others, maybe I'll take a stab at a general thought on that, and the others can add to it. As a general rule, inflation is, in real terms, so inflation adjusted, is bad for every asset. It just destabilizes things. It's bad. An economic slowdown is also going to be difficult. So maybe if we unbundle them and look at them separately. So any way you slice it, inflation is going to be difficult. Doesn't mean necessarily that it's going to be bad in nominal, like the actual price terms, because it's happened quite frequently in history that you had countries that have quite significant inflation and the stock markets keep going up. So if you had cash, you'd get left way behind. So I don't want to throw out stocks as a way to protect at least nominal value in an inflation. Never mind to get into some factors of owning shares of businesses who can adjust their prices higher. So, but in general, inflation's bad. If we then switch into the economic downturn problem area, I think the industries that are going to feel the most there are the ones that we've started to see the threat to, which is the leveraged financials. Whenever there's a problem, it's always the financials. And the old saying of good loans get made in bad times and bad loans get made in good times, I would think we've just had a ridiculous orgy of money. And you can be pretty sure there's some bad loans floating around. And the Silicon Valley Bank stuff, I mean, the irony is that those failures happen not because of credit. Normally bank failures happen because of credit. So if I had to guess, I'd say always look where the leverage is and recognize that probably some bad loans are floating around out there, and be careful of leveraged balance sheets. But that was my first thoughts. Any others?
I will add probably that certainly, inflation, as Peter said, is bad for all assets, but at least for companies of size with good balance sheets and strong products, people have to buy products and services, and typically they're going to be able to withstand tough times and be able to increase prices to remain viable and continue to grow. And so, but it is, we certainly hope that the central banks do win this battle and inflation does come back down and we don't go into a phase like we were in the 70s with double-digit inflation. I mean, even the recent readings in the UK were still over 10%, which, I think is not good for anything with inflation at those levels.
I think if I could add to that, the question on where we would see probably the most impacted in terms of the sector would possibly be in consumer non-discretionary, which is just products and services that the average human being can live without. So consumer discretionary probably would hold relatively well in terms of the performance of the earnings, but the companies and the products that we can do without will probably be hit the most if inflation remains very high.
Which, by the way, is ironic because we just came off the pandemic time where all anybody bought was the stuff they didn't need, so go figure.
But that makes sense, right? Because in rough times, people are just focused on what they need, yeah? I have a question from the audience.
I noticed in your presentation that you mentioned that there were headwinds in energy. In other words, that Fortress didn't have a lot of equities in energy. And obviously it was fairly clear that when Russia invaded Ukraine, that energy, oil was going to go through the roof. Of course, Fortress is high value, which is fantastic. Love that. But with those kind of slightly shorter term or medium term opportunities, would Fortress pivot a little bit and maybe invest in some of the higher value energy stocks like a Shell, Chevron, etc.?
Mark, thanks for the question. The best time to have bought oil stocks was mid-2020. I don't know if everybody in the room remembers when oil futures famously went negative and no one was ever going to use oil again. That was the time. And so I'll maybe recast your question in harsher terms. So where were you guys in 2020, right? And if I could cast our minds back to 2020 on the energy front, really nobody knew what was going to happen. I mean, really nobody knew about many things. And I would return to Roger's point about resilience, and I think Rashad's point about resilience too, that there are companies, as fill in the blank is happening, that are going to be doing okay. And energy, we just didn't know what was going to happen there. And I think then if we think of the category of company that energy is, it's not the kind that we want to own anyway. And we could make an argument this is changing, and I think Berkshire Hathaway has been accumulating huge positions now in Occidental Petroleum and some other energy companies on the understanding, as I believe it is, that the ups and downs of the energy industry are changing. It's moving more to a utility type of thing. But energy normally is just up and down. The companies tend not to have any durable growth. Like the graph we showed of the up and to the right, there isn't really up and to the right. They always overexplore, then they boom, then they bust. And then it's garbage, they're not making any money, and then production comes off. So it doesn't kind of, as a sector, it never really fit what we want long term. We don't feel there's a tailwind to it. So if we'd been really smart, we would have bought it in 2020, and I'm sorry that we didn't. But it probably, if it happened again, I don't think we'd buy that again, just because it doesn't have the nice growth tailwind of the kind of company that we like to see. It's the same for mining companies. You know, if you feel like it's just going to go like this, and they do for a while, and actually we're probably seeing a bit of that right now. There's some takeover activity in some of the mining companies. They just go into a frenzy, and then they overinvest, and then the things come right back down. And the overinvestment becomes its own problem, and then the underinvestment becomes its cure. And so maybe those things change, but that's been our starting point on those two industries.
I have two questions here on WhatsApp I want to get to. Though one of them I would really encourage the asker to ask in person. The first one is coming off of your point here about oil and energies products. Someone asked, what products are we at Fortress offering to investors with greater risk appetite? And I thought what you're describing sounds like something for somebody with greater risk appetite. And what is the strategy for investments in commodities?
I would say that maybe I could take a stab at the first one, that we really don't have a product that's focused on, for investors looking at risk appetite. So most of our things are, probably the riskiest thing that we have is our emerging markets fund, I would guess. But price the cheapest, but they're still in that fund. They're great companies at low prices, and I would not consider it. It's not going to be like crypto or the ARK fund or one of those things. So we're conservative investors, and we just don't have those products.
Right, because that's part of the investment philosophy.
Yeah.
And I think sometimes that's difficult for people to understand, because they say, well, there's these opportunities. You hear about these things doing so well. Why isn't Fortress giving us that access? But we have a methodology. So that's part of why that is.
I think Rashada's graph that showed crypto down 70% in the meme stocks and the ARK and so on, at the end of the day, I think it's one thing for any one of you all here. It's your money. You can take it and do what you so like with it. But for us to take your money and do that with it, I think we'd be rocks coming at us here this evening. I don't want to be sitting here to talk about that.
Probably more than rocks.
Yeah.
There was a question here about crypto, but I think it's one that we've answered year on year. And you've alluded to it just now in terms of Rashada's chart and the performance and fluctuation of crypto and those similar products. So I don't think that's something that we will be looking at in the near future, given our investment philosophy. There is a question here for Rennie.
I hope it's a hard one.
I'm not the CFA in this group.
Well, they didn't say Rennie, but it would have to be you. The trend for pensions has moved from NIS to DB, that is direct benefit, to DC, defined benefit, to DC, which is defined contribution, with a focus of moving the risk to the individual. Are there any potential trends or expectations for pension funds in the future?
Trends.
Yes. For pension funds in the future. We hope it's not a strategy.
Well, as I said when I was speaking to that slide, we were at defined benefit, pension lump sum, defined contribution, where the member takes all the risks. What's next on the new frontier? I'm not CFA. Charter holder. I honestly think it's somewhere in the middle with a solid, good Social Security scheme that's financially sustainable, as I mentioned before. So I don't see the employers opening the doors and welcoming everybody to defined benefit plans again. They're just at this stage not prepared to take on that risk. So I think the defined contribution is going to be here to stay for a little longer. And the risk stays with you and me, and we have to take most of the responsibility. But I do believe and strongly believe that behind all of that, there's a strong basic NAS that covers sort of basic needs. What that level is, of course, is open to debate. But I don't see the shift away from DC plans anytime yet.
Can I ask you, Rene, in the corporate world, the companies have gone away from DB schemes onto the defined contributions, with the employees taking all the investment risk and the longevity risk. It's not the same with governments. So the NIS scheme is a defined benefit scheme. The payments or the benefits are fixed. Do you see us get into a situation where governments say they're not prepared to take either the investment risk or the longevity risk, and we're now into governments going towards defined contribution schemes?
Well, I can tell you, Australia has gone full into defined contribution plan for its Social Security in a very big way. And they've done that for years. I guess, again, this will take serious discussion. Obviously, we're not going to solve it here. But, yeah, I mean, I guess everything is on the table. But I think given Barbados's defined benefit plan that exists now, I honestly feel the change that's going to come is going to be a cut in benefits. Not that I want it. As you can see from my hair, I'm very close to retirement. But that objective of making sure that, you can pay current benefits without jeopardizing the benefits of those that follow, if we accept that objective, then we have to look very seriously at whether, our current NAS is sustainable given its current benefit structure. But, let's not be here in 20 more years' time talking about this all over again. We got to get it right this year. So, yeah, I don't know what those changes will be, Roger.
Okay, there is a question from the audience. Yes.
Yeah. Hello. Yeah.
Hello.
Peter, I guess this would be for you. If you felt that you had to respond quickly to, I guess, potential changes, which you see as long-term in the markets, how nimble are the portfolios for you to be able to affect that change? And what are your thoughts on one hand, making the changes, and on the other hand, taking probably some realized losses?
Thank you for the question. Can I ask you a follow-up question? What's an example of the kind of change that you might have in mind that you'd want nimbleness to respond to, just so help me answer?
No, probably, as was brought up before, it could be some geopolitical change that you think could have long-term impact on the global markets. I don't have anything specific in mind, but...
Okay.
Good question.
Yeah, it's a great question. I'll just sit here for a second. Maybe one way to answer that is to think about the categories of things that we might consider to be requiring change, and then the kind of nimbleness that's possible. I think when it relates to most of our global portfolios, if it became necessary, I suppose in theory, most things could change quite rapidly. So it would be that our nimbleness would be high. As it relates to almost all of our Caribbean holdings in the Caribbean Growth Fund and the High Interest Fund in Barbados, the nimbleness factor would approach zero. Not from our side, but just the markets can't accept movement. So I think that would be the first cut, would be, are we talking Caribbean markets or global markets? And then if it's global markets, I would say, has a principle changed or has the manifestation of a principle changed? And if it is the case that sometimes markets become very dislocated and they move a lot, this part will move up this way, this one will move down this way, and what's our nimbleness to address that, where the current manifestation of cheap stuff is different than it was 2 days ago? Our nimbleness is high to that too. But I wouldn't want to leave, please, you or anybody in this room under the impression that we are looking for existential macro changes to whip the portfolios around, because we absolutely are not. We're looking to stay the course, be steady, but we're absolutely responsive and nimble if the markets start moving things around and the things we like get super expensive and other things are cheap. We have the ability to move the portfolio to respond to that.
All right, we have a question in the audience, and then I have one other WhatsApp question here that I would like us to treat to.
Good evening.
Good evening.
My question concerns the debt ceiling in the US and the possibility of Congress not raising the ceiling so that the threat of default approaches and possibly happens, which I personally think is unlikely, but just the threat, and we don't know exactly when the ceiling is going to be reached, but probably sometime in the summer, possibly early autumn. What strategies, if any, does Fortress have to take that into account, if any?
Thank you. It's a great question. And remember, we talked about things that kinds of news or things that are in the market versus things that are not in the market. I would suggest that the point you raised is not currently in the market. It's not something that everybody has gotten afraid of yet. And we've seen past episodes where this refers to the slightly archaic way that the U.S. requires back and forthing politically to approve the increase of a debt ceiling in order to continue even paying its debts. And it's used as a political opportunity with a lot of brinkmanship that can spook markets. So on the one hand, it's not in the market yet. On the other hand, markets have been quite spooked on it in the past, and maybe it's lost its ability to scare the markets, but I'm glad you raised it because it's in the category of things that I think are potential threats because they're not in the market yet. So your next part of your question is how can we do to safeguard our investments from that? I believe, unfortunately, that's in the category of things that we, as long-term investors, it's completely unknowable. And I think we have to recognize that whatever happens through that will just happen. And we'll have to respond in the way that we respond to markets generally. If prices change, we'll look at things and respond, and hopefully we can improve the portfolios if something changes. But I wouldn't want to leave anybody with the impression that we're able to predict that or respond in advance to something. It's firmly in the category of not the stuff that we can control, predict, or know, and it's possible it becomes a problem. If it does, there'll probably be opportunities for us to move the portfolio around, to move from less risky parts of the world into more risky parts of industries and so on. That's the kind of thing we'll do, but it's unpredictable would be the category, unfortunately. We'd have to put that in.
All right, there were 2 questions related to government paper. And this one is actually quite detailed, so I'll start with this one, or at least just leave it with this one. I think the answer to this will probably address some of the queries, or the other query. First Caribbean has invested, I think, $100 million in the Barbados economy in bonds. Does Fortress have an appetite for these bonds? Is a coupon rate of 4.5% enough to compensate investors for the risk of government paper in this environment? So first of all, before you dive into that, what does a 4.5% coupon rate mean?
So 4.5% means that you receive 4.5%
On the investment.
on your investment.
Good. Once we got that, so I know that gave Peter and Roger a chance to think.
It's a boss bond. Sounds like a boss bond.
This is being advertised on the way in
does
tonight, I
Fortress-
think.
Does Fortress have an appetite for these bonds?
Yeah, I would definitely say we have an appetite for government paper. We currently do hold some government bonds in our Caribbean high interest fund. In relation to the question of if the 4.5% is enough to compensate investors for the risk that we take buying the bonds, I mean, it's a hard question to answer, but if it was not enough, we could compensate via the discount rate that we apply to the bonds. So the discount rate is embedded in the price, and if we think that the 4.5% is not high enough to compensate for the risk that we're taking, we would simply buy the bonds at a more discounted price. So we would use a discount rate that we think is the appropriate amount to capture for the risk that we're onboarding.
And presumably that would be an option available to something like Fortress and not me walking up to wherever it is that you go to buy these bonds.
No, I mean, any person can, if you are interested in buying bonds, you can do it via
At a discount.
Commercial banks.
yeah, the commercial banks. You can go to a
Any
broker,
brokers.
and you can state your bid, which would be the amount that you will buy your bonds at, and you would assume whatever discount rate you think is appropriate for the risk that you're taking.
I think to pick up Rashada's point, I think we have been buyers of some of the, what I would call restructured bonds at lower prices and higher yields than that 4.5% rate. So some of the other bonds available on the market have been of more interest to us in our high interest fund than those at this point. But we have been buyers of government paper again.
Okay. And we have one other question here from the audience, near the front.
Hi, this question is for Renee. Two questions, Renee. I'd like to know a little bit more about the Australian model and how far that has spread around the globe, how long it has been around for. That's the easy question. The harder question is, if I was 45 years of age and I could afford to save $500 a month, in the current tax regime, why would I put it into a Fortress pension fund rather than an alternative investment fund under the Fortress umbrella?
Okay, first question, thanks. I'm not going to get too involved because, to be honest, I don't know the level of detail other than I know that Australia has gone very much into this defined contribution for its Social Security scheme. I certainly can get that information for you because I can see the book right now where I read all about it, so I can get that to you and anybody else that wants to know about Australia. As far as somebody who has disposable income, $500, whatever it is, and wants to invest and sock it away for pension, I agree 100%. Don't put it in a registered retirement savings plan. Put it in a mutual fund. Simple. It's in the same investment vehicle that your RRSP would have been in. If it had the tax allowance still, it would have made sense to put it in a RRSP. That's been removed. Don't put it in there because of the no double taxation. So just put it straight into a mutual fund or a credit union account or the Ovaltine tin, something. Yeah? But don't put it in the RRSP because it's just not tax efficient.
Renee, I think when you say don't put it in RSP, that applies generally because they're no longer tax efficient.
Correct.
But when you say that you get the same benefits invested in a Fortress mutual fund, that is not necessarily general, that's specific to us. Because
No,
our
any mutual
RRSPs,
fund.
our RRSPs are invested in our mutual funds.
Yes,
Right, so our RSPs act as an umbrella for our mutual funds.
correct.
Right, so if you say, it's not necessarily the same thing if you had an RSP from somewhere else.
So just don't put it in a RSP, but other companies sell them too, so same concept, same concept applies.
All right, I have like one more question there, and I think then we're gonna have to wrap up.
Okay, so I just wanted to know, in 19 months' time, I think I've worked it out, my math is correct. In 19 months' time, there's going to be a general election in the United States. And on the one hand, you're going to have a guy who's 80 and probably takes a couple of hours nap in the afternoon. And then on the other hand, there's a distinct possibility that it could be the Trump factor, unless he, of course, gets locked up. The big question, obviously, I don't think anybody can bet against Trump. I was recently in Philadelphia, and on driving to the airport, I asked the guy in the taxi, I said, who do you think is going to, win this election in 19 months? And he said, well, Trump, of course. So what do you think we should, how would Fortress handle that kind of volatility that's going to be around in 19 months' time? Of course, we got a lot of US stocks, but there's going to be anything that Trump does is volatile to say the least, and the markets like consistency and stability. So I'll just leave you with that one there.
Mark, I think Rashada will need a wider scale on her volatility graph, it sounds like.
It's going to be an issue. But having said that, I would put that in the category of things at this point that are always present. And we think of them in the category of the what about blank. If you're thinking about taking risk, and you rightly point out, markets like certainty. Except the reality is that markets never have certainty. There's the underlying fundamentals, and then there's all the manic depressive garbage that goes on around it. And at the end of the day, the underlying reality kind of winds up muddling along and being usually what it is. And so the what about blank could be anything. It can be what about China? It can be what about Taiwan? It can be what about Ukraine? What about energy prices in Europe? What about politics in the United States? So it's certainly not to diminish the concern at all. It's very real, but I think it's in the category of things that we'll just have to work around and see what happens. If sometimes with politics, especially in the U.S., it can cause movements among sectors. Healthcare sometimes comes into the fray because of different proposals, and sometimes they'll get crushed or rally like stink. So what we find is useful from a portfolio management point of view is when things like that happen, because that's something we can respond to, because you've got business with kind of discernible prospects whose prices are moving around a lot. That's very helpful to investors like us, because we can respond hopefully semi-nimbly to that. But yeah, if it's going to just cause a whole bunch of ups and downs, I think we're just going to have to work through it the best we can. Yeah.
I think Warren Buffett says it best in many of his annual letters, never bet against America. So despite that, I think it is going to be, it would be a very interesting political situation, but I think you still, and prices may reflect the uncertainty, but over the long term, it will probably prove to be an exceptional buying opportunity.
All right, now I'm going to ask the audience a question. We are approaching the time that we had planned to be finished. Do you all have appetite for 2 more questions? Yeah? Good to go? All right. All right, so somebody asked, in a previous investment forum, thank you for coming again, you didn't want to invest in Barbados government bonds. What has changed? And since we're talking about change this evening, yeah. Yes. So what has changed? Why are we now interested in government paper when at some previous time we were not?
Maybe I could take a stab at that one. I think for those of you who came to some of the earlier forums, Barbados's debt situation was continuing to rise. We saw there was successive downgrades by the international rating agencies. I think we even had one of the people that worked on debt restructuring, Mr. David Nagoski, was a guest speaker in one of our forums. I remember we had a graph up there with an iceberg and so on under it. So we knew that a debt restructuring was inevitable, and it did happen in 2018. And that's obviously changed the situation significantly. We're under IMF program, and the plan is to bring Barbados's debt situation back down to a much more manageable level. Now, there is assumptions in that require a level of growth in the economy to be able to repay these loans. I think that there's restructuring that we know needs to happen, but we're under IMF program, and the good news is that our foreign reserves are back to levels that are probably some of the highest that we've seen in a long time. And so I think the debt situation is still extremely high. Barbados is one of the highest indebted countries, I think, in the world, and that has not changed yet, but hopefully the plan is to do so. So generally, I would say that it is a better credit risk now than it was back in that forum when we were trying to avoid that. I would let Peter or Rashada see what comments you have.
Yeah, I mean, if we cast our minds back to before 2018, I mean, we stood on this same stage and we put pictures of whatever we could think of, like sharks leaping out of the water and eating seals and things, like just anything that would help communicate that we felt there was a danger to government bonds, and nobody really felt there was an issue. And then I think now everybody in the room understands that there was an issue. So we didn't have any significant positions of government bonds going in, but once the situations change, our views change, and the IMF program helps, the actions of the restructuring helped, and the availability of bonds in the secondary market at yields that at least started to compensate for the risks helped as well. So when you can buy short-term amortizing bonds at the beginning of an IMF program on yields of 8%, which is what we were doing aggressively, that seemed to make some sense. To buy government bonds that you know are about to, or you suspect are going to be restructured soon at yields of 5 or 6, it just was a non-starter. So the situation changed dramatically. And not to put too fine a point on it now, but we're not quite ready to put sharks eating seals on the screen yet. But we're heading in that direction again if we're not careful. So
I think to add to that as well, it's really useful to keep in mind that cash can be sometimes a drag on yield, and there are not many opportunities to effectively deploy cash, especially in bonds in Barbados, and government bonds now provide somewhat a relatively compensated opportunity to do that. And as I was saying before, even if we think that the risk is somewhat elevated, we could kind of compensate for that for buying the bonds at a much discounted price. But in terms of the availability of options and opportunities to deploy cash in bonds, it's not really there, and government bonds provide us an opportunity to do that.
I mean, maybe I could return to the previous question just very briefly, because I think the question was asked, so I mean, maybe that helps shed some light on why we, for an example of someone who changed their minds about bonds, but they won't be changed forever. But I think the question was around, does 4.5% compensate investors for the risks? And I think this is just one of those big unspoken things. But this issue with having a very weak sovereign in this capital trapped environment that we all exist in, it's a huge issue that affects all of us, or that we should all be aware of. Because in my opinion, 4.5% does not come anywhere close to compensating any of us for the risks in a government bond. However, there are other factors. What else do you do with the cash? Your capital's trapped. Keep in ... So I think those are the kinds of things that go into the cocktail of developing an opinion on things like that.
Yeah, and I would say for everyone in this room, you're faced with extremely low deposit rates in commercial banks. They're 0.2%. We know the inflation levels are, money sitting there is being eroded by inflation. So, what do you do? And but as Peter's point, 4.5% for the risk when you can buy a U.S. Treasury bill now, 1-year T-bill with 4% is a very different versus a 5-year Boss bond, slightly higher rate. So it's not an easy situation that we face here in Barbados.
You mentioned the inflation there a minute, and we did have a question earlier about that, asking whether any of Fortress's investment funds growing faster than the rate of inflation? So are any of our US dollar or Barbados dollar investment funds growing faster than the rate of inflation?
They certainly didn't last year, did they?
I would respond by saying depends over what time frame. So over long term, yes. Short term, no.
That's kind of the point of a mutual fund, long term.
Exactly. We did in 2021, but certainly didn't in 2022.
Well, every year is not the same.
No.
And that's also the thing about mutual funds, which is why it's long term, because it's not the same thing every year. Do we have any more questions from the audience? All right. I thank you all for your questions. At this point, I'm going to invite a special guest to join us on stage.
Good night, everyone, and thank you for attending the 11th Annual Investment Forum. I am the Office Manager at Fortress Fund Managers Limited, and I'm here to say a few words about Roger, seeing he's leaving Fortress at the end of next month. I first met Roger at my interview back in 2001, and I started to work at Fortress Fund Managers Limited on January 14, 2002. So Roger and I have been work colleagues for the past 21 years. Back then, there were only 4 of us, and now we have blossomed into 17 team members. It makes me feel so old. My interview with Roger was one of the easiest interviews I've ever attended. Over the years, Roger has exhibited several beautiful qualities. He's compassionate, hospitable, punctual, dedicated, and appreciative. At some points in life, we all have to deal with personal issues for whatever reason, and when these issues arise, Roger would say, "Don't mind here, go and deal with your business, we would manage." For me, that means a lot, and it puts me at ease not having to worry about work at a time when you have personal issues to deal with. When clients or business associates come to the office, he would always ask if they want coffee, tea, or water. Roger is very customer focused, always looking for ways to make it easier and convenient for the client. Even though Roger is a boss, and if he's running late, which is very rare, he will call or message to say he is running late, and when he arrives, he will say, "Good afternoon," because in his eyes, the day has gone by and he hasn't started to work. And sometimes it's just by a few minutes. I remember a few years back, Roger had surgery done on his knee, and I'm sure he was on sick leave. You would think he would stay home and rest? No, not at all. He came to work on crutches. I don't think Roger has ever taken full sick leave given to by the doctor. Once he thinks he's well enough, off to work he goes. Roger shows appreciation and thanks for tasks and assignments he has given. He will often say, "Well done," and when you hear that, you know that he's happy. Over the years, we have had to work on various projects which fell outside of work time, and it didn't feel like a chore or a burden. But when you least expect it, you're rewarded, and that for me builds staff morale and esteem, and I feel appreciated. For those of us at Fortress, we will miss the sayings that are unique to Roger, and the things he would do, for example, leaving quarter or half a slice of cake or of sweet bread on the lunch table because a whole slice is way too much for him to eat. But he wouldn't do that with chocolate. It will be consumed in whole portions. Chocolate is his weakness. Roger, for the last 26 years plus a few months, you have been answering the phone, Fortress, good morning or good afternoon. But I feel when you take up your new post, so that no one is confused as to where they have called, you can say Roger Cave speaking. Because I know Fortress will be at the tip of your tongue and when you pick up the phone. But I'll leave it to you to decide what you'll do. Roger, even though you're leaving Fortress, your firstborn, to take care of your parent, Kay Shepherd, we understand that it was a hard decision, but you will take care of Kay Shepherd just as well as you did at Fortress Fund Managers Limited. We will miss you, and I want to take this opportunity to express my appreciation to you for your confidence in me and your hard work and dedication to Fortress. I also want to wish you all the best in your new role at Kay Shepherd. So it's not goodbye, because we know that you will visit us occasionally and surprise us by popping in. So thanks and all the best. And I will end by saying, coming to work every day and not seeing your chirpy face will be a painful anguish. But the fun memories we've shared at work will never diminish. I will now invite Peter to give his closing remarks.
Thank you, Tina.
That's really hard
Thank
to
you,
follow
Tina.
up on. Just one thing I forgot to mention, sorry about that. The WhatsApp questions that were not answered tonight, we're going to follow up with you in the coming week or two. So not to worry, we didn't ignore your questions. We were just trying to fit in as many as we could. All right, Peter?
Thank you very much, Kim. And Tina, thank you. That was lovely. So it's my job to wrap up, and I'm standing between all of you in the bar, not where somebody wants to be. I think what I would do here tonight is go back to where Roger started at the beginning of the night, which is about the question of financial security. It's really what brought us all here tonight. It's the reason that Fortress exists, is to help people achieve it, hopefully in a semi-pleasant way. And we've all hopefully contributed to that tonight, you by being here and asking your questions, so thank you again. Hopefully the team here by sharing what things we do know and hopefully admitting the things that we don't. So I'd like to thank everybody who made tonight possible. I'd like to recognize, first of all, Roger for making Fortress possible. If we could have, please, one more round of applause. I'd also like to recognize Mr. John Williams, who is the current CEO at Kay Shepherd and chairman of Fortress. John is with us this evening. He is going to be heading off into retirement soon, but he's contributed many things to this company over the years, and I'd like to thank him very much for that as well. Thank you to Kim for leading the charge and organizing tonight. Thank you for every member of the Fortress team. You met many of them as you came in, and you've seen them here on stage and not on stage tonight. I've all done a lot of work. It's a small company. Everybody chips in to make an event like this happen. And I think it's a testament to the kind of company you're dealing with here. Everybody is here tonight working to make this thing hopefully enjoyable and a success. I'd like to thank the staff of Frank Collmore Hall and the folks who've helped with our AV and everything else. And at this moment, I think all that's left to do is to thank all of you again for coming on this rainy night. And I look forward to having a drink and a snack and having a chat with all of you after. Thank you again.
Thank you. So with the thanks being concluded, just some housekeeping for everyone. ICAB members, you can collect your CPD credits at the registration desk. An assortment of thank you items are in the lobby for you, and we do invite you for refreshments on the terrace in the lobby. Additionally, if you want to review any of your questions and the answers, or if you want to share the information seen and heard here this evening, in the next few weeks, we are going to post this whole presentation on the Fortress Fund YouTube channel, so stay tuned for that. So we'll join you in the lobby shortly.